welcome to The Appointment. My guest today is someone who's a master of banking, a master of merchant banking, investment banking, and a master of capital markets. Yes, there are not so many, so you would have guessed. Mr. Uday Kotak, Vice Chairman and Managing Director of Kotak Mahindra Bank. Mr. Kotak, thank you very much for joining me. And it's a very opportune time that we've got you. Before I get to nitty-gritties of Indian banking, which is throwing up a lot of questions, first up on the global markets itself, 2016 has been treacherous, to say the least. Does it look like the markets have overpriced in a recession, or are they overpricing in incompetence of central bankers?
I think on a global situation, a few factors are working at the same time. First of all, the black box called China. Second is the reverse impact of a hugely negative commodity cycle on those companies and future investments by those companies. Third is the implications on the banking system coming out of the low commodity prices, as well as excessive leverage which many of the corporates are having worldwide.
Yeah, but is all this getting overpriced? I mean, it's true that, the Chinese economic model is changing. But does it really merit this kind of a 25% meltdown in 5 weeks?
I think it's a very good question, and the classic example is Japan. When Japan went to negative interest rates, one would have assumed that the yen would weaken. In fact, the yen strengthened, contrary to traditional economics, and the Japanese markets went down. I think we are reaching a situation where the markets are beginning to question the efficacy of quantitative easing, and also the question to central banks that beyond the one medicine which you use for all problems, what next? And the second question is to the political class globally, that where are the structural reforms needed to improve the fundamentals of economics?
To be fair, Dr. Rajan has been raising this issue from Kingdom Come, that central bankers should not pose themselves as the only game in town. But nevertheless, I mean, I'm asking you a question for answer to which every investor is seeking. Should we price much more downsides to global markets?
My strong belief is, in turbulent times, go back to fundamentals. Therefore, ask the questions on the earnings of companies, sustainability of those earnings, fairness of the price-earnings ratio, rather than being carried away by momentum. Therefore, go back and do your homework on fundamentals.
You know, the Chinese central bank over the weekend actually put out a very clear statement. For the first time, the governor spoke to the media and very clearly said that, it's not our game to depreciate the yuan. And, we are 600 billion surplus in terms of exports in a year without depreciating the yuan. Do you think, therefore, that the bottom has been hit? Are we all overpricing a Chinese confusion?
Latha, the question is outflows from China. The month of January, as I understand, saw $100 billion outflow. So this is a good confidence-building measure. But the key to me is, what is the individual Chinese feeling about his or her money in China? If he or she wants to take out the $50,000, that's not a good sign. So we have to watch post this confidence-building measure, whether this is for real. As I understand, on the ground in China, if an individual today applies to his or her bank for a 50,000 rupees withdrawal, the banks are not allowing it in a hurry, though it is permitted under the guidelines. So when this is done in normal course, I would believe the confidence which has been put out.
Well, that's hopefully, for the moment at least, the worst is over. We'll have to wait and see. But actually, that brings us to the question of the India investor. What's the sense? Do we go down with the globe, or do you think we can outperform in 2016?
I love to compare India to a situation which I call as a long term. I think India is looking extremely robust from a macro point of view. Therefore, if you look at India macro, it's never been this good. 10 years ago, if you had asked me, Uday, what is the dream for India macro? We are there. Okay? But I think the problem is micro. And India's micro is more challenging in a good macro. The tailwind of macro must be used by micro to improve the situation. And the current pain is coming out of micro.
I'll have more questions on those micros, especially because your sector, the banking sector, is bearing the brunt of bad micros. But before that, let me come to your conference itself. You know, your conference theme was chasing growth last year. It remains chasing growth. Is it becoming a mirage? Or are you seeing any tangible difference between last year and now?
Latha, you have to answer that question with a question I will ask. India is going to show 7.6% growth. So growth is up. The question is, what is our confidence that those numbers are something which we have a conviction are the levels of growth India has? If it has, then the growth is better than last year. So why are we complaining?
No, macro numbers we all know. But Mr. Kotak, you handle a lot of micros yourself. Between last year and now, are your borrowers asking for more working capital? Are you funding more projects? Are your retail clients asking for more money? You would know better. Are you seeing growth?
The urban consumer is in very good shape and continues to be comfortable. The challenge, if at all, is we have had 2 bad monsoons. So that's putting pressure on rural India. I think the budget hopefully will address it aggressively. And as far as the corporate sector business model in India is concerned, it is fundamentally broken.
Okay.
And what I mean by broken is that between 2005 and 2010, corporate India went in for what I call as arbitrage. Arbitrage on resources, whether it's coal, telecom, infrastructure, real estate. Get resources cheap and arbitrage out the price. That model is gone. You now have a transparent mechanism, an auction mechanism, where you're not going to make money on arbitrage. You're going to make money on productivity and efficiency. And corporate India is still not coming to terms with this new world.
Is it not coming to terms at all? Are you seeing, you know, some of the top 10 leveraged groups, are you seeing some better behavior in terms of deleveraging, selling off shares, selling off assets?
See, Latha, when everyone is in one direction, valuations dramatically correct. And that's the challenge we are beginning to face. If the valuations go down to that level, it has a challenge on the valuations of the debt. So you are in a little bit of a cycle. As I say, debt can be virtuous or vicious. At the moment, you're seeing the viciousness of debt.
Okay, so you're not yet, you don't think the worst has played out yet. We could see, you're yet to see the green shoots in corporate India.
No, my view is what we are currently seeing is still reflection of historical stock problem.
Yes.
The flow problem is not there. So you're not seeing dramatic creation of new bad or stress loans in the system. This is still reality of the past. We are just recognizing it now.
Okay. Well, let me then come to that itself. The banking sector, the big news really is each bank outdoing the other in terms of recognizing the dirt. What is the sense? We saw Bank of Baroda come out and say very boldly that they are done with cleaning. So do you think we have at least got our hands around the problem?
I think we are moving in the right direction. This is the first time we are beginning to see the baggage of the past at least getting washed. We need to see this happen consistently over the next 4 to 6 quarters, where we come to a situation where we can say that we have no baggage. And when we reach that situation, whether it is the banking system or the banks or the policymakers, we should then avoid any further pretense and not have any baggage genuinely.
Okay. But is the worst known? Or can there be unknowns in terms of...
You're in markets, you're in volatility, you're in a fast-moving global world. My personal view is that we are moving in the direction towards bottoming out, and we will see it sooner rather than later.
Okay, you don't think it is bottomed out? I mean, in the sense, not just India, but other countries, the European countries have also put up minimum import prices or some kinds of barriers against steel dumping. well, crude also saw 25. Does it get worse? So are we bottomed or still bottoming?
Let me move to fundamentals, because, making judgments without fundamentals is always dangerous. Our equity research believes Nifty earnings for March 2017 to be around 470 rupees a share. And their fundamental view, which I share, is the fundamental value of the market is somewhere around 14 and a half times 470 rupees, which gives you a fundamental floor in a sense of around 6,600 to 6,800 Nifty. Now, markets can move on either side of this fundamental value, but for the first time we are seeing our markets now begin to look at valuations which are significantly more fundamental rather than momentum. Now, can 6,800 reflect to be 7,200? Yes. Can 6,800 be 6,500? Yes. But broadly, we feel we are coming to some sort of a range on fundamental value in the marketplace.
Okay. Well, that's actually very encouraging. But just to scratch that point one bit more, do you see earnings growth? Does your research team and you share the confidence that FY17 there will be that kind of double-digit earnings growth?
We believe so. We believe that earnings will pick up, particularly in the second half of FY17.
Okay, on that optimistic note, or cautiously optimistic as the cliche goes, I'll take a break. But we have lots more questions for Mr. Kotak. One on the upcoming budget, and more importantly on his sector, the banking sector, which is facing challenges not only from bad loans, but also from the digitization of financial transactions. All that in a minute.